Hi, I'm Steve from Clearly Training, and you're watching our Finance for Non-Finance People video series. And this is number 2, and this is all about something called accruals. And accruals is really important. In particular, it's important for preparing the profit and loss account. We also use it for the balance sheet, by the way, but it's in particular important for the profit and loss account. And I'm going to focus on the profit and loss account and how the profit and loss account is different to the cash flow statement by using a simple example. So I'm going to get on with that very shortly. But before that, I just want to remind you or tell you about the principles of accruals accounting. So accruals accounting is relevant, very relevant indeed, to the profit and loss account. You can't produce a profit and loss account unless you use the accruals principle. It's a basic fundamental accounting principle. And I also mention here, it does apply to the balance sheet as well. Don't forget that. But we're looking at it on the profit and loss account in this video primarily. Okay, secondly, the accruals principle says that income should be included in the profit and loss account when it is earned, not when it is received. It should be included when it's earned. Now, sometimes income is earned and received in the same period, but often it isn't. Often income is earned in one period. We invoice a customer, they don't pay us until the next period. So we include, as accountants, we include income in the profit and loss account when it's earned. And we've got the same principle for expenses or expenditure. Expenses or expenditure are included in the profit and loss account when they're incurred. So sometimes expenditure is incurred and paid in the same period. But when it's not, when, for example, we incur expenditure 1 month, but we don't pay the bill until 1 or 2, 3 months later, then in that situation, the profit and loss account says, put the income in when you actually incurred it, not when you paid it out. So those are fundamental principles when we're preparing a profit and loss account. And we're going to see how those principles apply in our simple example. Our simple example, and my example, is about a plumber called Charlie. And Charlie decides to set himself up in a new plumbing business from the 1st of January in our fictional year there. And in order to set himself up in that business, he has to incur some expenses. So the first thing is he has to rent a lockup. He needs somewhere to put all his tools, and if he's got a vehicle, he needs somewhere to store that, and any stuff he's bought and he needs to deliver to his customers, he needs to store that there. So he rents this lockup, and the person who's renting him it, his landlord, says, well, I want £900 in advance. So in January, I want you to pay me £900, but that payment, that rental payment, is for January and February and March. So we've paid £900, but it's for 3 months. So effectively, the rent is £300 a month. We just happen to have paid it all in the first month. Secondly, Charlie rents a van. So he goes and rents a vehicle. He takes out a lease on the vehicle. Now, the lease is for 12 months. He's been optimistic. He's thinking, well, I'll stay in business for 12 months. So he's leased it. He's got a legal contract to lease it for 12 months, and it's £200 per month. Now, this person, the lessor who's leasing him the van, has actually been fairly kind to Charlie and said, look, you don't have to pay us the first month's payment of £200 until the beginning of February. So Charlie pays nothing out in January on that vehicle, although he's using the vehicle for the whole of January. He's had it in January. He's due to pay for it, but he doesn't actually pay for it until the beginning of February. The third thing is great news for Charlie. In January, he got his first customer, and he agreed with the customer that he would fit a new bathroom suite, including all the tiling, and make it absolutely beautiful. And he's going to charge the customer £4,000. So in order to fulfill that contract, he had to go to the wholesaler. And when he went to the wholesaler, because he was a new customer of the wholesaler said, look, Charlie, this time, the first time you buy from us, you've got to pay cash. So Charlie had to buy all of the equipment, the bath and the basin and the toilet and all the tiles and grout and everything else that he's needed. He had to buy it all for cash. So he paid the £2,200 cash in the first month, in the month of January. And also in January, he had a couple of other expenses. He had to pay for his petrol. He paid £100 for petrol that he used in the van to get backwards and forwards to the wholesaler, backwards and forwards to the job. And lastly, he paid £50 advertising. He's a very modern plumber. He advertises on Facebook, and he paid them £50 to advertise. And actually, that's where his first customer came from. His first customer had seen him because the first customer was a friend of one of his Facebook friends, and he got recommended to Charlie, and that's how he got that first job. Oh, and by the way, I should mention about the first job. It is in the information that £4,000 job that Charlie did, and he finished it, by the way, before the end of January, and he sent out the bill before the end of January. He didn't get paid. Customer was going to pay him in February, and I can tell you, by the way, that he did actually get paid. Yeah, so he didn't actually get the cash in January. He didn't get the cash until February, but he did finish the job, and he did send the invoice in January. So how's that going to look in our financial statements? How's it going to look in our profit and loss account and our cash flow? So let's have a look. On the left, I've produced a pro forma for the cash flow statement, and I'm just going to fill that in with all the different categories that would go on that cash flow statement. And on the right, I've produced a profit and loss account. And we're going to talk through what would go in there. But the reason I've produced the pro formas, I'll talk you through them in a second. The reason I've produced them, I'm just clicking up the different categories now. The reason they're there is because you can stop the video and you can get a pen and piece of paper or whatever, and you can have a go at filling them in yourself. And you should all be able to do the cash flow one. You might struggle a little bit with the profit and loss account, but it's a good little exercise to have a go at it, thinking about those principles about when you put income in and when you put expenses in the profit and loss account. And even if you don't get it all right, at least you start in that thought process. If you don't want to do that, that's fine. I'm going to talk you through it on the next slide. But I've flicked up the cash flow statement there. You can see what it looks like. We've got cash received at the top, and then we've got all the different categories of cash payment below. And so this is just a stylized version of a bank statement, just a bank statement, but with incomes and payments put into different categories. So we'll list all those out. And by the end of the period, by the end of January, you'll see whether there was any cash coming in or going out. And there's no secret in this example, because you didn't actually receive any cash from the customer in January, that you've actually got a net cash payment in January. Okay, so that's the cash flow statement. And then on the profit and loss account, well, we start the profit and loss account at the top with our revenue, what we've earned in the period, our revenue. That's one of the terms we can use. We can also use other terms like turnover or income, but I'm going to use revenue here to show what we've earned. And then we have what we call our cost of sales. Now, our cost of sales are all the direct costs of creating the sale. So in this respect, the cost of sales will include all of the things that we've paid out for the bathroom suite and the tiles and all of the things that we've fitted into the customer's property. And in a profit and loss account, we always have a little subtotal. We take the revenue less the direct costs or cost of sales, and we have a little subtotal, and we call that the gross profit. That's gross profit. Gross means big in German, and it's the big profit, the profit before deducting the overheads. And the overheads are all the ancillary costs. So what sort of things are we looking at there? Well, the fuel in the van, the rental costs that we've had. We've got the rental of the lockup. We've got the rental of the van. And we've also got the advertising, the Facebook advertising. They're all our overheads, our ancillary costs. We couldn't run the business without those things. We wouldn't have got a customer if we hadn't advertised on Facebook, would we? Poor old Charlie. Yeah, that's where he's getting his customers from. So all those costs are really important. We call them overheads because they're ancillary to the running of the business. Okay. And once we take the income less the direct costs, get the gross profit, and then we deduct from that gross profit all of those overheads, then we get the profit, or we could also refer to that as the operating profit of the business. And he is actually making a profit in this example. So I'm going to look now at the actual results of his trading and how it impacts on the cash flow statement and how it impacts on the P&L account. So let's have a look at that. So the first thing is cash received, nothing. We didn't get a single penny in this month of January. Oh dear, oh dear. Cash paid, though, we had lots of cash paid. First of all, we had to pay out for those things, the bath and the sink and all the rest of it, so we could get those goods for the customer. And that cost us £2,200. We had to pay the wholesaler. We paid the petrol, £100 for the petrol as well. Yeah, that was another cash payment. For the van rental, we were lucky there because they didn't want any cash until February. So that was good in terms of our cash flow. It kept our cash outflow down a little bit. But we did have to pay for that lockup, and we had a rather large amount to pay for that because we had to pay for all 3 months up front. So that was a bit of a bad one. And we had to pay for that Facebook marketing, but at least it got us our customer, even though we haven't got any cash from them yet. So all in all, we paid out a lot of money in that first month. So you can see the cash outflow there, 3,250 going out of Charlie's business. So hopefully Charlie's agreed an overdraft with the bank, or maybe Charlie had some money of his own put in to start the business up, to give the business a bit of positive cash flow, because as he looks at the moment, the bank's not going to be very happy with him unless he's put some money into his bank account personally. Okay, so that's the cash flow. The cash flow gives a negative impression of how Charlie's business has done in the first month, but just using common sense, you know, I would say that he's had a good month because he made that sale. Look there on the screen. He's made the sale of £4,000. He did make that sale in the month. He did earn the money. He did finish the job, and the customer is going to pay him. You might think this is us as accountants being a little bit optimistic, and we're not known for our optimism, are we? The accountancy breed. We're not really seen as being very optimistic people, but accountants take realistic views and they say, look, in reality, a business will only trade, it will only make sales if it thinks it's going to get the cash. You would be stupid, wouldn't you, to start trading if you didn't think you were going to get paid? And most of the time, most businesses do get paid. So we put the income in when we earn it. We earned it in January. We didn't receive it yet, but we did earn it. So we put it in. Then we put the cost of sales in. Now, in this example, the cost of sales is an example of where we had expenditure that was paid in the month and it was also incurred in the month. So you see the same figure in the profit and loss account and the cash flow statement. Yeah. Whereas with the revenue, we earned the revenue in the month, but we didn't receive it in the month. So we get a difference between the two statements. Our gross profit is just the revenue less that cost of sales, or direct costs, it's also known. And that gives us a gross profit of 1,800. And then we've got the overheads. And what overheads have we got? Well, the first overhead we've got is we've got the fuel for the van. So £100. And again, the amount incurred is the same as the amount paid. So the profit and loss account and cash flow have got the same figure in. And then we've got the van rental. Now, here's a difference. We incurred a cost of 200, but we didn't spend it in the month. It won't be spent until February, but it relates to January. So we put it in January's P&L because that's when it was incurred. Then we've got the lockup. Now, here's another one where there's a difference, but this time the amount paid in the cash flow is much higher than the amount that was actually incurred in the profit and loss account, because only a third of the payment we made actually relates to this month of January. So we only put the £300 in. Only a third of it relates to this month. And then £300 we'll put into February's profit and loss account, and £300 we'll put into March's profit and loss account. That's how we do it. We spread it, or we match it to the appropriate month. Okay. And lastly, we've got the marketing, and the marketing is another example of where we've incurred the same amount as we've spent. So the P&L and the cash flow do match up there. So the profit and loss account gives a different story to the cash flow statement. You can see down there, we've made a decent profit at the bottom in our profit and loss account. And as far as the accountant's concerned, that's the truth. That's how well the business is really performing. Of course, we've got to keep a check on cash flow for the reasons I said before, because the bank won't like it. You know, we want to make sure the bank keeps supporting us, but this business underlying is a good business. It can turn a profit in the month, because what the P&L has done is it's lined up all of the income and expenses that relates to this month. It's matched them to the appropriate month that they relate to, and it's shown that a profit is being made, even though it's only the first month. So of course, if the bank was thinking about giving us an overdraft, it'd be nice to show them that profit and loss account. And the bank would have confidence in the business, and it'd have confidence in Charlie. And that is why we use the accruals principle, and that is how we use the accruals principle in the profit and loss account. Now, a couple of other things before we leave that, because the accruals principle is also used in the balance sheet. So a couple of things, you know, the balance sheet, because we've got revenue that we've put in the profit and loss account of £4,000, the balance sheet will show that we have a customer that owes us £4,000. That will be shown in the balance sheet. So there is that interaction between the profit and loss account and the balance sheet. They both use the accruals concept. Okay, let's look and finish off by looking at some other uses of the term accruals. So we've already seen the accruals principle and how it works. You know, income is included when it's earned, expenses are included when they're incurred. So we've already covered that. But what if somebody said to you an accrual? What if somebody used the word an accrual, the phrase an accrual? How might they use that? Well, what might happen is if you're a manager in a business, your finance team might say to you, have you got any accruals at the end of the month? What would they mean by that? Well, if you're running a department in a business, and let's say you have a vehicle in that department and you've had that vehicle repaired and you know it's been repaired in the month, but you also know that you haven't received the bill for it yet. Now, if you haven't received the bill for it, the finance team sitting over there in finance, they won't know anything about this repair. So you will let them know that you've had the repair and you'll tell them how much you think the bill's going to be. So we've had the van repaired. We think the bill is going to be £200. Yes, it was repaired this month. So the accountant will then say, we want to make an accrual of £200. And what they will do is they will show in the balance sheet that the business owes £200 at the end of the month. And it will also show a cost of repairs in the profit and loss account of £200. That's what an accrual is. The finance team will say they have made an accrual for the cost of the repair because, you know, they haven't already seen the invoice, so they need to make an adjustment to the accounts for the month. As I've just mentioned there is a connection here between the accrual idea and a creditor idea. Okay, and this is the connection. So sticking with our example, we've had the van repaired in the month. If we haven't yet received the bill, the finance team won't know anything about it. So we have to make an accrual. We have to tell them about it, and an accrual will be made, an adjustment will be made in the accounts. But if we've had the van repaired in the month and a bill, an invoice has already been sent from the repair shop and our finance team have already got that bill for £200, then we won't need to make an accrual because that bill of £200 will already be in the financial statements. It will already be on our system. The accountant will know about it. The accountant will still put the £200 cost into the month and there will still be a £200 liability. But this time we will refer to it as a trade creditor simply because we've got the bill. So the difference between the accrual when we haven't got the bill and the trade creditor when we have got the bill is the receipt of the bill. Once a bill's been received, we call it a trade creditor or payable, we can also call it. Before the bill's been received, we will need to make an accrual in the financial statements. Okay. As I keep saying, the accruals principle applies to the balance sheet, and I've given you some examples of what happens when we've got accruals, how those accruals impact on our balance sheet. Okay, so at the end of each of these presentations, as I've said before, there's a couple of questions for you to have a look at. So just have a look at those questions, first of all, and then I'll go through them. You might want to pause the video, as I've said before, so you can answer them. I'm going to give you the answers in just a second. Okay, so the first question, just one answer is correct there. So when we've got this repair in March, same example that I used before, but we've paid for the repair in April, which of those is false? Well, the answer is number 3. The expense will not go into the P&L in April. The expense will, of course, go into the P&L in March, as in answer number 1. The cash flow will go in April because that's when the cash is actually paid. And there will be an accrual in the balance sheet in March. Again, I covered that in our previous example. So the right answer to the first question is 3. That's the right answer. The wrong one, the one that is wrong of those 4 is number 3. So that's the answer you should have got there. And question 2. Now, question 2, you can have more than one answer. You can have more than one answer. So question 2, which statement does the accruals principle apply to? Well, it applies to number 1 and number 2. The accruals principle applies to the profit and loss account and to the balance sheet. It doesn't apply to the cash flow statement. So the correct answer is 1 and 2 there, not 3. Okay, hope you got those. If not, as always, go back over the video and make sure you check your understanding and that you understand the principles fully, and then move on to the next video, which is all about the balance sheet. I'm Steve from Clearly Training, and I'll see you on the next video. Thank you. Bye-bye.